The crypto market feels like it's holding its breath right now. One analyst just cashed out an $80,000 Bitcoin profit, convinced a big dip is coming before one last rally. Another warns that money could start flooding out of altcoins and back into Bitcoin as early as September. Even the charts are looking a bit shaky, with some pointing to a potential drop to the $100,000 range after a key support line was broken. But is this just another dip or the start of something bigger? The old rules might not apply anymore. With big institutional money in the game from ETFs, some experts believe this cycle could stretch all the way into 2026. Plus, with talk of clear U.S. regulations on the way and companies actually using chains like XRPL for business, the entire space is changing fast. Where do you think the market is headed next? In the latest video from Altcoin Daily, the hosts sit down with Mark and Bruno from the Algorand Foundation to talk about what's next for the blockchain. They explain that Algorand is a layer 1 that has impressively never had any downtime in 6 years. Its main selling point is something they call instant finality, which means transactions are confirmed immediately without any chance of being reversed. This makes for a super smooth Web 2-like experience for users. It's interesting to hear Algorand's leadership frame their strategy this way. For a while, Algorand has been known in crypto circles as a project with fantastic technology that hasn't quite captured the same explosive user growth as chains like Solana. The points about zero downtime and instant finality are legitimate technical advantages. Their new roadmap seems to lean into this strength by targeting a different market altogether. Instead of chasing retail hype, they're clearly setting themselves up to be the reliable, compliant, and secure choice for institutions and real-world assets. This pivot towards being the serious blockchain for business and finance could be a smart long-term play, even if it doesn't generate flashy headlines every day. The success of this plan will likely depend on whether they can actually land the major institutional partners they're aiming for. In the latest video from Crypto Rover, he explains why he closed his Bitcoin long trade, banking an $80,000 profit. He thinks Bitcoin is about to dip before making one last big move to the upside. He's noticed that Bitcoin is forming a topping pattern similar to what it's done in past cycles, and he's also seeing a bearish divergence on the weekly chart. Despite these warning signs, he doesn't believe the top is in just yet, suggesting we might have about 6 or 7 weeks left in this bull run. He's betting on a short-term correction to grab liquidity, a pattern he says Bitcoin has repeated many times. To capitalize on this, he's setting up new buy orders between $111,000 and $109,000 to catch the dip before the final rally. It seems Crypto Rover is tapping into a common feeling in the market right now, a mix of excitement and nervousness. His strategy of taking profits and waiting for a dip to re-enter is a classic move when the market feels overextended but not quite finished. The idea that Ethereum will outperform Bitcoin at the end of a cycle is a very popular theory that has played out before, and many are watching the ETH Bitcoin chart for confirmation. His focus on the upcoming jobless claims and Powell's speech makes a lot of sense. Lately, crypto has been very sensitive to macroeconomic news, especially anything related to interest rate policies, so those 2 days could definitely bring the volatility he's anticipating. In the latest video from the Crypto Tips channel, we're told that market cap is one of the most deceptive numbers in crypto. If you're using it to find undervalued coins, you might be walking into a trap. The video explains that market cap is just the token's price multiplied by its circulating supply. The problem is that price can be pumped with just a tiny amount of trading, and the circulating supply is often just a small piece of the total tokens that will ever exist. This video nails a timeless problem in crypto, but it's gotten even more extreme lately. Many new projects are launching with less than 5% of their tokens in circulation, creating astronomical FDVs from day one. It feels like a deliberate strategy to engineer a supply shock and create a flashy pump that draws in tons of attention and retail money. While a low float can create explosive upward moves, it also means the cliff on the other side is that much steeper. It seems the market is split. Some traders specifically look for these low float plays for quick gains, while long-term investors are becoming much more wary of projects with poor tokenomics, no matter how good the technology seems. It's a reminder that the token's economic design is just as important as the project's roadmap. In the latest video from Lark Davis, he questions whether the crypto market will see its peak in 2025 following the traditional four-year cycle or if we're in for a longer ride into 2026. He argues that this time is different mainly because of big institutional money, which ties Bitcoin's fate more closely to the wider economy. The arguments for an extended cycle into 2026 feel pretty solid. What this video touches on is that the entire structure of the crypto market has changed. The launch of Bitcoin ETFs wasn't just another news event. It fundamentally altered who is buying and holding Bitcoin. We're now dealing with institutional-grade capital, which moves slower and is far more influenced by broad economic data like interest rates and liquidity than by crypto-native narratives like the halving. The old four-year cycles were largely a retail-driven phenomenon. Now, crypto is on Wall Street's radar, and their game is a marathon, not a sprint. This shift likely means longer, less explosive growth phases, which fits perfectly with the 2026 theory. The market just doesn't feel like it's in the final euphoric stage yet. In the latest video from the Ben Cowan channel, he lays out his case for why the party for altcoins might be coming to an end soon. He's noticed that even though Bitcoin dropped about 10% against the dollar, altcoins have been surprisingly resilient against Bitcoin itself, continuing to slowly climb. However, he doesn't think this will last. Cowan's main prediction is that we'll see a big rotation of money out of altcoins and back into Bitcoin starting in September. Cowan's take is a really solid dose of realism in a market often fueled by pure hype. His argument about the Fed funds rate versus the neutral rate is particularly sharp because it looks past the simple headline of rate cuts are good. It suggests the degree of the cut and its relation to the broader economy matter more than the cut itself. Right now, the market is buzzing with excitement over the Ethereum ETF and other altcoin developments, which is likely what's propping up their prices against Bitcoin. This sets up a classic conflict, a hot narrative clashing with cold macroeconomic data. Cowan is betting that the macro conditions will ultimately win this round. Given how previous cycles have played out, watching for a reversal in September seems like a very sensible and data-supported position. In the latest video from Coin Bureau, Guy breaks down a huge potential shift in U.S. crypto regulation. It all starts with a new blueprint from President Trump's crypto working group, which has set off what's being called the CFTC's crypto sprint. The goal is to create a golden age of crypto by setting up clear rules, and things are moving incredibly fast. It's interesting to see the video frame this as a current event, but it really outlines a potential future under a different administration. The contrast between this proposed approach and the current one is stark. For years, the American crypto industry has operated under a cloud of uncertainty, often dealing with regulation through enforcement actions from Gary Gensler's SEC. This proposed sprint by the CFTC, working alongside a reformed SEC, represents the kind of proactive, clear framework the industry has been asking for. If this were to happen, it could seriously shift the global balance, making the U.S. a much more attractive place for crypto businesses and developers who have been increasingly looking to friendlier places like Dubai or Singapore. It moves the conversation from "what are we not allowed to do" to "here's how you can operate legally." In the latest video from DataDash, Paul Sampson tackles the big question on everyone's mind. Is the recent market dip the start of something serious, or just the market catching its breath? He points out that Bitcoin's weekly chart isn't looking its best after it briefly hit a new high of around $125,000, only to fall back to the $115,000 range. This move, called a sweep of the highs, can often signal a downturn. The cautious but still optimistic view in the video really captures the current market mood. It feels like we're walking on a tightrope. On one hand, you have major players like MicroStrategy doubling down, which signals strong belief in the long-term value. But on the other hand, the broader economic environment is still a bit uncertain, and that always seems to put a lid on explosive price moves. The idea that Bitcoin could sweep the lows to gather steam for another run-up is interesting because we've seen that exact pattern play out so many times before. It shakes out the nervous sellers right before the market turns around. It seems the market is waiting for a clear signal, either from a major economic report or a significant move in the traditional markets, before committing to a firm direction. In the latest video from Crypto Wendy, she talks about a new trend where companies add crypto to their balance sheets, but with a twist. She points to a NASDAQ-listed pharma distributor, Well Logistics, as a prime example of how to do it right. Instead of just buying and holding an asset, Well Logistics is actually building its business on the XRP ledger, XRPL. They've launched a payment system for over 6,500 U.S. pharmacies that uses XRPL to enable instant settlements, which helps cut down on bank delays and card fees. On top of using the technology, Well Logistics is also adding XRP to its treasury as a reserve asset. Wendy feels this shows a deep confidence in the project's utility, not just its price. She then addresses some negative news from a DL News report about a Keiko security review that ranked the XRP ledger last due to centralization concerns. Wendy pushes back on this, saying the ecosystem is still growing, especially after the lawsuit. She notes that Ripple's own new stablecoin, RLUSD, will run on both XRPL and Ethereum, suggesting Ripple knows it needs to build out its ledger while also using Ethereum's massive network. The Well Logistics partnership is a significant step for Ripple and XRP because it represents tangible, real-world utility, something the community has long championed. It shifts the narrative from pure speculation to practical application in the B2B payment space. However, the security and decentralization concerns brought up by the Keiko report are valid points of discussion in the broader crypto community. While the XRPL is designed for speed and low-cost transactions, its validator structure is often compared to more decentralized networks like Bitcoin or Ethereum. Ripple's decision to launch its stablecoin on both XRPL and Ethereum is a very pragmatic business move. It shows they understand where the current liquidity and developer activity is Ethereum, while still working to build their own ecosystem's appeal. It's a strategy that leverages the best of both worlds rather than relying purely on one's own chain. In the latest video from The Modern Investor, we get a tour of countries that are rolling out the red carpet for crypto enthusiasts with some seriously attractive tax laws. The discussion starts by looking back at Portugal, which was one of the first to offer a 0% tax rate on crypto, creating a blueprint for attracting capital. The main idea is that countries with friendly economic policies, not necessarily just zero tax, will see money flow to their shores. People who save on taxes tend to spend and invest locally, boosting the economy in other ways, like through property taxes. It's interesting to see how the global competition for crypto capital is playing out. The video lays out a great list, but what's really fascinating is the evolution of these havens. The UAE, for instance, isn't just offering zero tax, it's building a complete regulated ecosystem with its VARA authority to attract serious businesses and institutional money. This feels more sustainable than just a simple tax gimmick. On the other hand, a country like Portugal, which was a pioneer, has recently changed its popular NHR tax program for new residents. This shows that these favorable laws aren't always set in stone and can shift with political winds. This whole dynamic creates a fascinating push and pull, forcing larger economies that have been slow to create clear rules to either adapt or risk seeing talent and capital continue to move elsewhere. In the latest video from CryptoJeb, he explains why a big corrective move for Bitcoin seems very likely right now. He points out that Bitcoin just broke a critical uptrending support line, which is a much bigger deal than the flat support level at $112,000. Because this trend line has been broken, he's making a specific prediction. If Bitcoin doesn't get back above $115,000 in the next 3 days, he expects it to fall back into the $100,000 to $105,000 range. The lowest he sees it going is around $92,000, which would be a test of the entire bull market's main support trend. This analysis feels pretty grounded in what's happening on the charts right now. The idea that a correction could actually strengthen the long-term case for Bitcoin by preventing a wild, unsustainable rally is a compelling one. We are seeing some signs of slowing momentum, with recent outflows from Bitcoin ETFs suggesting some institutional players are taking profits. Jeb's supercycle theory taps into a wider conversation about whether the ETFs have fundamentally changed Bitcoin's market structure. It makes sense that with bigger, more patient money in the game, the classic volatile cycles might smooth out into a more prolonged, grinding uptrend. A drop to $100,000 would certainly shake out a lot of nervous hands, but it could also set the stage for the next sustainable move up if his theory holds.